session will be recorded for the media and for future purposes. I want to walk all of us through some few housekeeping rules so we will all be guided. We will entreat all members to mute so your background may not interfere with proceedings. Sometimes it can be a huge nuisance. So if you are not speaking and your environment is not quiet, we will encourage you to please mute. When we get to the Q&A session, we would allow you to use the reaction button to raise your hand and we will call your attention to speak. We will also take advantage of the chat box for you to put any questions, queries that you may have. In case you have any technical challenge, people are on standby, our technicians are on standby to help you out. Just send us, give us a quick indication and we will come back to help you resolve your issues. At this moment, Kemen Apia, who is our Vice President, to give us the welcome and purpose of today's session. Lady Reverend, please, you have the floor.
Thank you very much, Dr. Boateng. And so the voice that you just heard is Dr. Boateng. Dr. Boateng happens to be a member of the Institute, also sitting on council and the chairman for the Awards Technical Committee. As you may be aware, we are rounding up to the 13th of December, where we see who wins what in the IoD flagship program, the Corporate Governance Excellence Awards. Ladies and gentlemen, once again, we have gathered to sharpen our sword. What is the cause for this sharpening? We have heard about the budget that has been put before us, though yet to be approved. We have seen the challenges. We are forecasting. We have some concerns. We have some fears. But as responsible directors, we want to be able to appreciate the risks and to learn how to navigate them. So the purpose of this gathering is for us to listen to subject matter experts as they walk us through the actual and potential boulders on our path to success and as they lead us in how best to navigate the path. So ladies and gentlemen, this is the main reason for calling this gathering. You are now in the able hands of Dr. Frank Boateng, who will moderate the session to its end. Thank you very much.
Thank you very much, Lady Reverend, for setting the stage for us. I think at this juncture, we will call on Mr. President, Mr. Rockson K. Dogbegah, Fellow of the Institute and then the President of Institute of Directors, Ghana. He is also the President of the Association's African, the Continental President. So, Mr. President, please, you're welcome to give us the opening remarks.
Thank you very, very much, Dr. Frank Boateng. So on the African continent, I represent the African Corporate Governance Network. Thank you. Good morning, our distinguished members of the Institute of Directors, Ghana, our speakers, and our guests. As directors, we represent the hearts, the minds, and the souls of our organizations, and we provide the strategic direction for the management of our organizations. The need to be aware of our internal and external environment issues is therefore very critical to enable us to develop the appropriate strategies for the proper performance of our organizations. Following the presentation of the 2023 budget by the government of the Republic of Ghana, The need to have a conversation to understand the direction of government becomes very critical as we plan for the strategic direction for organizations in 2023. We have assembled very seasoned speakers and panelists this morning to discuss the critical elements in the 2023 budget statement to equip us as directors as we navigate the turbulent economic environment in the country. Distinguished ladies and gentlemen, before we get started, I wish to use this opportunity to announce that we have a new CEO in the person of Mr. Clement Wiridu. He'll be introduced to us at the end of our program today. And let me also use the opportunity to thank our strategic partners, the Bank of Ghana, KPMG, VRA, GOIL, for supporting the Institute in its quest to champion good governance culture in the country. I wish you all a good engagement. Thank you.
Thank you very much, Mr. President. You always push for governance, and we are so proud of you, and even doing this from the continental stage. I will move on to the next agenda for today's discussion. We will take a keynote address, and this person will be looking at corporate governance implications of policy measures in the 2023 budget. The focus will be on the role of the board of directors and required partnership between government and private sector. And in this, the person that is going to deliver this for us is a governance and a public financial management expert. He is a chartered accountant and a lawyer. He practiced previously from the Chamber of Coil IB & Co., and he has served as the head of finance and accounts at the Institute of Local Government Studies between 2000 and 2010. He also served as a senior lecturer in local government finance, fiscal decentralization, public financial management, and public sector accounting in the same institute, rising to become the founding dean of graduate studies and research of the same institute. Currently, he is a director of the Internal Audit Agency. Ladies and gentlemen, let's welcome Dr. Oduro Osae, who is also a member of the Institute of Directors Ghana. Doc, you have the floor, sir.
Okay, good morning, and thank you very much for this opportunity to be of service to Mother Ghana. And I also want to thank the Institute for constantly championing good corporate governance in the Republic of Ghana. Basically, like Mr. Redu said, my presentation is on the corporate governance implications of the 2023 budget. We are all aware that we are not in good times, to the extent that the 2023 budget that was read has an aim to reset the economy and restore macro stability. What it means is that there is an issue of macro stability, and all of us will have a role to play because we are in part of the macro environment. And this budget has a 7-point agenda. The 7-point agenda touches on each and every aspect of the businesses in which we operate. Government intends to aggressively mobilize domestic revenue, and government domestic revenue can be mobilized through taxation. And taxation has a direct impact on the work we do. Government intends to streamline and rationalize expenditure. Most of us does a lot of businesses with government. And if government spends, then our business can grow. So if government is going to streamline and rationalize expenditure, it means we have to also re-strategize and understand the times in which we are. Government intends to boost local productive capacity. It opens a business opportunity for us as businesses. But if we are board members and then directors, what kinds of direction are we going to give to our organizations to be able to take advantage of government policy of boosting local productive capacity? The fourth one is to government aims at promoting and diversifying export. This opens a business opportunity for us as well. government intends to expand digital and climate responsive physical infrastructure, another opportunity for us. And finally, government intends to implement structural public sector reforms. Now, these public sector reforms interfaces with the private sector. It then means that as IoD members, members of various boards and directors, unless we reposition our organizations, we will not be able to take advantage of the provisions in this budget. However, there are three critical success factors that are to be available for the government to be successful. The first one is successful negotiation of a strong IMF program. And we all know in all countries that anytime there's an IMF program, it doesn't only affect the public sector, it also affects the private sector, it affects businesses. The question then is, how are we going to reposition ourselves, provide the required directions, psych our directors to be able to operate our businesses in such a way that will continue to maintain our leadership in the sector and also continue to be in business. Government is also going to coordination of an equitable debt operations program. That has even started with government's announcement of a debt exchange program. That is a big issue for board of directors and directors to be concerned about. They should not be concerned about it in the negative, but in the positive, because it is likely to have an impact on our debt structure or our financing structure. What does it mean for our business? The last one is attracting significant green investment. Now, be it as it may, government intends to implement the budget by incurring a total expenditure of about 205 billion and an overall fiscal deficit balance of 61 billion. Government deficit is funded from borrowing. So obviously, there is something to do with our financing. If we are not very careful and we don't manage our finances well, either we'll be crowded out of the market or we may have capital at a very expensive cost. Question then is, what do we do as businesses? As directors and members of boards and then professional directors, our role as board members to start with is basically three. We are required to provide oversight, we are required to provide insight, and we are required to provide foresight as well. Now, if we are doing our oversight work well, then it means we should be able to understand what is happening in the external and internal business environment. And the budget is such an important document. The second one is that we should be able to give the business foresight. And to give the business foresight, we have to build a team that will think strategically, think universally, and think tactically. If we miss these three things, then we will not be able to provide the required foresight for businesses. I always say that if you have the right board of directors with the right skills mix, and you have the right directors with the right psyche, they will be able to turn around the most unfortunate business situation to a business opportunity. And that is what makes us professional directors. So I want us to understand that, or position ourselves that no matter what the 2023 budget presents to us, we have been trained as professional directors to think strategically, to think universally, and think tactically by turning around challenges to opportunities for business growth. And here, let me say that as board and as directors, the first thing we need to do is, one, the 2023 budget has challenged us for a policy and strategy review for a new direction for our businesses. If any board fails to appreciate the implications as far as the policy measures in the budget are concerned, to review its strategic policy for the organization and provide a new direction for business sustainability and growth, your business will collapse. And the onus is on the board members, and as professionals as we are, we should see this as a challenge. How do we do this? Let us try to ascertain the current state of our organizations in the context of the macroeconomic statistics and the projected fiscal and inflation figures government has announced in the 2023 budget. Let us target achievable goals in the context of the policy measures. I know that most of us will have our strategic plan. We are running those strategic plans. We even have concluded our 2023 work plans. But this is the time for a revision so that we revise it to we target achievable goals in the context of the new policy measures. If we are not very careful, we would overprice ourselves, or we would outcompete ourselves from the market. The third level is let us choose low-hanging fruits as far as targets, goals, prioritization are concerned, so that we will be able to maintain our business leadership in the industry in which we operate. If you're not very careful and we set higher unattainable targets for our board of directors or for our management, we may end up not achieving it. We will lose our place in the business and the industry. The multiplier effect will be negative as far as our business output is concerned. So my advice is that let us choose low-hanging fruits. Let us have a target achievable goals on a modest basis, but still keeping in mind our business leadership mentality. And then finally, we should not leave our management behind. We should carry them along. The next area of strategy for boards and professional directors is the way the budget is and the way the government intends coordinating a debt restructuring arrangement, which on its own is a requirement for us to clinch a staff level agreement with the IMF. It will then require that almost immediately, every board would have to sit with its management to review its financing structures, business processes, and financial management systems almost immediately, taking into consideration what is likely to happen in the context of the policy measures announced by government. But in doing this, I would advise boards and directors to also keep an eye on the environmental and industrial impact on the proposed strategies. We'll go into the strategies very soon, but the other advice is that let us use this management by objective process to get everybody on board. It would also require of us to revise the key performance indicators we have set for management, and even for the board ourselves, because there are certain KPIs that were set without appreciating the policy measures announced in 2023 budget. So we may have to do a revision so we'll be able to operate within appreciable limit. The next area of intervention and strategy is that I would encourage boards and professional directors to consider a process of starting an engagement with regulators of our financial markets. And here, I would encourage that we have some discussions with the Bank of Ghana, the Securities and Exchange Commission, the National Insurance Commission, the National Pensions Regulatory Authorities, and other such institutions. The importance of this engagement is that it gives you some level of assurance. It provides you the insights you need to provide the foresight and the direction to the organization. It helps you to act on the basis of evidence-based information or evidence-based data, so that your projections will be very accurate and you will still be in business. There are a lot of boards and directors who do not do a lot of engagement with these regulators, but from the way the 2023 budget is structured, constant engagement with the regulators or constant communication with the regulators to get raw facts relevant to your work to inform decision-making will be critical going forward. I would also suggest that you start a process of looking at your enterprise risk management processes, especially your risk management policy and risk register, because the 2023 budget is going to expose you to new levels of risk. And if you have not anticipated this risk, managing the risk would also be very important. The bottom line is boards and directors, let us be continuously vigilant and monitor the macro and microeconomic as well as the fiscal space of government, because in the coming days, government is going to announce a lot of measures which would have a positive impact on our businesses. The other one is to also advise the board that looking at the policy measures and indicators provided for in the budget, as a board, you have to work with your directors in such a way that you promote business value addition to all your processes. Give your clients, your stakeholders, your customers, your consumers, the reason to say that you are still relevant in business. And here, you need to maintain a strong monitoring and control system and a strong partnership with your clients. As much as possible, please develop leading capabilities in terms of resources, methodology, and technology. And like I said, start a process to engender confidence in your key stakeholders of your continuous relevance in business as far as the 2023 budget is concerned. If you fail to do this, you would be out of business because you haven't been able to convince your client or your stakeholders of your continuous relevance in the midst of all the challenges in your business. It will require that as board of directors and professional directors, it will require that you have an up-to-date industrial and functional insight into your operational processes. It would also require that no matter what, you have to give a reason to your stakeholders to indicate why you are supposed to be in business. And here, it requires you to build what we call a business case. And building a perpetual business case calls for a board of directors who are very dynamic and up to speed with what is happening internationally and locally. Build a business case. And building a business case requires that you strike a good balance between risk, cost, and value for your businesses. A lot of measures have been announced in the budget, and I would expect that all boards and all directors will take advantage of the budget and turn it around. Like I always say, a businessman is the one who turns challenges into opportunities. During the COVID period, we had a lot of businesses making money, but a lot of businesses also, institutions lost their businesses. Why? They were not able to benefit from the direction of their boards to turn around challenges into opportunities. Colleagues, let us take up the challenge and say that there are business opportunities in the 2023 budget. And once we have these business opportunities in the 2023 budget, we are going to take advantage of it and then make sure that at least we benefit from the entire processes. What has government announced its intention to do? Government has announced that it is going to boost local productive capacity. And here, government intends cutting imports of public sector institutions that rely on imports either for inputs or consumption by 50%. Now, once they are going to cut this import, automatically it creates a business opportunity, 50% business opportunity within the country. Yours is to look at the industry or the sectors whose imports are going to be cut and start developing a business advantage within that particular sector. Government is also going to support aggressive production of strategic substitute, so import substitute industries. Now here, I would expect that boards and directors will quickly start doing the analysis and see how best they can partner with institutions like Ministry of Trade, institutions like Ghana Export Promotion Authority, institutions like Ghana Investment Promotion Center, institutions like Ghana Enterprises Authority, to be able to establish quickly the strategic business substitute government intends to establish and where the funding can be obtained from. Government also intends supporting large-scale agricultural and agribusiness interventions. And here, government intends doing it through Development Bank of Ghana. So I would expect that businesses that are in that area, the board will quickly have to start engaging with even the Development Bank of Ghana and see whether there will be some level of support there. Government is also going to protect and incubate newly formed domestic industries so that we'll be able to provide some level of competition to foreign institutions. Again, government is also going to pursue efficiency in government expenditure measures. I indicated that anytime government spends, the private sector benefits. Good businessmen and women position themselves to benefit from government expenditure, because government will spend by buying goods and services, or government will spend by constructing roads, or government will spend by even paying workers. If government pays government workers, the government workers would also use it to buy something or a service produced or rendered by the private sector. So the multiplier effect is there. Government intends to inject efficiency in its operations. Currently, government procurement is being automated. So then government is using the Ghana electronic procurement process. And from where I sit, I see that a lot of private institutions have not been able to understand how to bid government procurement processes on the system. So the few who have been able to specialize in bidding through the procurement system without bringing hard copy bid document are the ones getting the jobs. And at times, procurement bid will be floated on the GANEPs and you will not get anybody to bid because they don't have the capacity. I know Public Procurement Authority is building enough capacity. If I were you, board of directors and directors of institutions, let us start a process of building the capacity of 2 or 3 of our workers in this GANEP system, so that we'll be able to constantly, it should be somebody's job to sit behind the machine and check on the system whether government has floated any bid in there for you to be able to bid electronically. And I tell you, it is the most easiest bid to win. You don't need to know anybody. You don't need to have any contact with anybody. Yours is to understand how the system works and bid through the system. No hard copy document. The most important thing is to have soft copy of all your relevant documents so you'll be able to upload it. This is an important area that the boards and directors will quickly have to take advantage of and get businesses for their organization. Government is also reducing threshold on earmark funds from 25% to 17.5%, which has an implication on the work we do. And government is also placed a cap on the salary adjustment of SOEs. And here, professional directors and board members who are members of SOE boards, what is coming requires that there's going to be a freeze on the board of on the salaries of the directors or chief executive of SOEs, unless it is linked to revenue or income. And here it is going to be negotiated base pay increase on the single spine level. And this will require that we need to sit with our chief executive and look at the KPIs again. This is very, very important. Government is reducing fuel allocation to political appointees. So what it means is that those of us who operate in the fuel energy sector, especially oil, where people use fuel coupons to come and buy the fuel, you are not likely to get a lot of fuel coupons coming to you now because government is cutting it. What will be the alternative? So you have to quickly come up with a business strategy for you to continue to lead in the business processes. Government is saying that all government vehicles must use GV number plates. This is a good business opportunity for those who manufacture or those who develop the business plates. You can partner with DVLA. DVLA can come up with it because now from 1st January, almost all government institutions will rush to the DVLA to have their number laid embargo on official foreign travels for all heads of SOEs and also board members. And this will require an enforcement. If government has placed an embargo on them, how are we going to benefit from the savings that we are likely to make? So all these things support government business. And now government is also saying that government-sponsored external training and staff development should be held within the premises of government institutions. It means it's going to have an impact on the operations of hotels, conference centers, etc. What will be the business case for us? What will be the best alternative for us? Well, those of us who target government institutions to be running annual conferences in our hotels and industries or in our conference rooms, we are no more going to get them as it used to be. But this is not to say that we should not be in business. We should be able to find a very good opportunity to come up with new programs that would encourage other operators in the private sector to take up that particular space. No printing of diaries, notepads, calendars, or other promotional merchandise by government institutions for 2024. Nobody is to print diaries. So those in the printing industry, you are not going to get the money from government. What will be your alternative? It is the duty of the board to come out with some guidance on that. Public funds will no more be used to purchase and distribute hampers in 2022. We are in December. This is not the first time this policy is coming. When I quite remember when the former President Atta Mills first came to office, that was the directive he gave, and it worked. What it then means is that some people will be out of business. If they are going to be out of business, what will be the best alternative? You cannot target government institutions, but now you can target private institutions. How do we come up with a model business case that helps us in all situations? The E-levy, a revision of the E-levy from 1.5% to 1%, and now it applies to all transactions. There should be a good business case for us. If we are going to transact our business electronically, what is going to be the additional cost to our operations? Are we going to pass it on to the customers, or we are going to absorb it? And if we are going to absorb it, is it going to affect our service quality? These and other matters would have to be considered. the increase in VAT from 2.5% by 2.5% is also something that we need to look at. There are also other areas that I think I need to mention, that government is going to also impose a debt limit on non-concessional financing, including placing a moratorium on new financing for 2023. Like I said, private sector institutions and boards get money when government spends. So if government is not going to spend, we are going to have challenges. Government is going to conduct a major review of the operations of 36 state-owned enterprises. And here, the boards and directors of those institutions must set up, because the review that is going to be done together with SIGA will come up with a number of outcomes. So we should be able to do a quick internal review and have a draft self-review document to inform the review government is going to undertake. Else, the review might go against us. Apart from that, if you sit as a board to allow an external reviewer to come and review and tell you what is happening in your own organization, you may have failed one way or the other in delivering your mandate as far as serving on the board is concerned. I know that is not what IOD teaches us. IOD teaches us to be very proactive. So let us start doing it ourselves. Government is going to review the operations of 8 special purpose vehicles, 90 joint venture companies, 38 regulatory institutions, 68 statutory bodies, and 6 subvented agencies. All these institutions have directors, they have boards. The advice I'm giving on this platform is that the board must initiate a self-review process ahead of time and know the pros and cons and have a business case with a number of scenarios to present to government before the government initiate that process. In that case, we would have been seen to be very proactive in identifying our challenges and then even joining the government to come up with proposed solutions. All in all, I'll end with the measures put in place by GRA. Colleagues, GRA intends increasing the government tax to GDP ratio from current 13% to 18%. And GRA has started the process of automating the tax mobilization process. That business scenario creates a good business opportunity for a lot of operators in the sector, because the 10-pillar technology transformation program that GRA is introducing is one thing that I think they should market to all businesses. The first one is a cashless policy. Once they are introducing a cashless policy and you have to pay your taxes not through cash by using a system, you have to understand how the system works to be able to be legally compliant. Else, it will affect your regulatory functions and it may have dire consequences on your operations. The board must be interested in ensuring that management understands the cashless policy of GRA so they are able to comply and also take advantage of a business opportunity that is there. Online filing system. GRA has introduced an online filing system where you don't need to carry your tax filing papers to GRA. You can file it online. This is something that must encourage non-defaultment of taxes. So if your financial statement is sent to you as a board and it is in the financial statement that the institution has defaulted in the payment of taxes because they were relying on a certain tax expert to come and file it for them, now there is an online filing system. And there is also an issue of third-party data sharing, that under the Data Protection Act, the third-party data sharing can happen, but it requires some level of clearance. So you need to understand this. And then also, the GRA is introducing what we call taxpayer experience feedback mechanism. My advice is that board members, professional directors, let us acquaint ourselves with the 10-pillar technology transformation program for GRA. 1, for regulatory compliance. 2, to be able to take advantage of the business opportunity that this particular 10-point agenda presents to us. The government, finally, is introducing a unified common platform for property rate administration. Government, through GRA, is going to support all the assemblies in Ghana to be able to properly mobilize property tax or property that would ensure that all the property rates, so then your properties will be valued, and then a current value will be placed on your property, and you are required to pay the realistic property. So those of us who have not been paying realistic property rate, now we are going to pay realistic property rate. But I mean, interested in the business case there. If a unified of the management of the unified platform and you for a commission to be paid to them, definitely they will do some printing. So my advice is that even as government introduces a unified common platform for property rate administration for all the 261 district assemblies in Ghana, let us see the business opportunity in there, even as and when we strategize to be able to manage our finances through the payment of realistic salaries, the realistic property taxes. Government is also going to operationalize a local content under the Minerals Commission's functions. We can take advantage of that. And then lastly, government has various fishing land sites at various levels of completion. This is going to open a huge business opportunity for operators along the beaches. Axim, they said the Axim land site is about 95% completion. Let us have the foresight and think ahead and see the business opportunities these things will open for us. That of Discof is 94%. The fishing ports at Muri, 96%. They are doing one at Mountford. It is at 97% completion. All these things are in the budget. There's another one at Osu, which is at 97% completion. Another one at Keta, 99% completion. Once they finish with this artisanal landing site, canoe production, selling of fishing nets, mending of fishing nets, cold stores, and then transportation are going to be good booming businesses in these areas. These present business opportunities for all of us, but it requires a dynamic director, a dynamic leadership. It requires a dynamic board to be able to provide the required leadership. So I want to thank you very much. In doing all of this, I see a lot of opportunities for us as directors. However, we have to be professionally positioning ourselves to work strategically with the private sector, because the work of government is to create an enabling environment for business to thrive. So once the budget is approved, that environment has been created. Ours is to look at their business opportunities in it and then implement it in the spirit of good corporate governance practices and carry our board of our management and directors along. Finally, please let us provide foresight after obtaining insight. And once we do this, there will always be a business case for our relevance so that our stakeholders will know that come what may, we have a business to execute. As directors, as board, ours is to provide directions. The management implement approved decisions. Once we are able to provide direction, they have work to do. We will be able to build this country together. Any foreigner that comes is coming to help us. We should be able to build this country. And I know IoD has an important role to create or to promote good corporate governance and also train all of us to be professional directors and see the business opportunities in document and macroeconomic fiscal policies like this so that we'll continue to be relevant to our dear country. Thank you very much.
Thank you very much, Dr. Oduro. You have really given us a deeper insights into what we should expect as directors, and we really appreciate. I want you to stay a little longer with us, so when we go into the panel discussion, we can open up some of the spaces that you have created as far as the discourse is concerned. We will move on to take our second speaker, and please, I would want us to restrict to the 20 minutes that is allocated so we can get enough time when we get to the panel discussion. So we are looking at the 2023 budget and the strategic implications on businesses. And here we are calling on Mr. Evans Asare from KPMG. Mr. Evans Asare is an associate director at KPMG. So we'll call Mr. Evans Asare to okay, to pick the stage and begin with his presentations. 20 minutes, sir. Thank you.
Thank you, Dr. Boateng. I hope you can hear me. Good morning to everyone.
Good morning.
Great. And I hope you can also see my presentation on your screens.
Yes, sir.
Great. So my job is to give a highlight of the 2023 budget statement. And I think Dr. Oduro Osae has done quite a yeoman's job by giving a very comprehensive overview and presentation on some of the opportunities. So this year's budget is themed Restoring and Sustaining Macroeconomic Stability and Resilience through Inclusive Growth and Value Addition. My presentation will follow this outline. We'll look at a snapshot of the 2022 macroeconomic data. I mean, where have we come from? Because we need to understand the challenges we faced in the past couple of years that have necessitated these new measures that the government has put together in the 2023 budget. And then we'll look at the targets for 2023 and what are the strategic pillars or anchors that will hold the fort. And then finally, we'll look at the implications for businesses and then how we can take advantages of some of the opportunities in there. So the key macro indicators that I have shown on this slide, I mean, I think just recently we saw the Bank of Ghana has upped the monetary policy rate from the 24.5% to 27%. So today we're looking at a MPR of 27%. Inflation is around 40.4% as at October 2022. GDP growth rate is around 4% mid-year estimates. If we look at some of the fiscals in terms of our interest payments and expenditure items, we're looking at almost 50% of our revenue for 2022 being used to pay just interest on borrowings of government or public debt. If you add compensation of public sector workers to that, then we are looking at more than 80% to 90% of our revenue going into servicing just interest payments and making payments to government workers. If you look at total tax revenue for the third quarter of this year, we are looking at 49.1 billion, quite far lower than what we estimate would probably be accrued for the year, even if you do some projections. Fiscal development side, if you look at total revenue and grants, as at the third quarter, it's about 65 billion, whilst we're estimating revenue in excess of 100 billion, which means that government revenue estimates might be quite challenging to achieve, even though if you look at expenditure, we seem to have slipped a bit. We have spent a little bit more than even the revised targets that government put together during the mid-year budget. Let's come to our debt position. So you look at our debt situation, we are, if you exclude the ESLA and then all the energy sector debt and then the financial cleanup costs, then our public debt to GDP is about 76% as at September 2022. But we know that if you put all the other debts together, including the energy sector, the financial sector cleanup, and all that, then our debt to GDP ratio is over 100%, really. I mean, and that is what the IMF really is asking government to probably put together. That's really accentuates the situation we are in, that our entire public debt to GDP is over 100%, which puts us in a very risky situation. So it is not surprising that our rating agencies have really brought us down to the C's, categories, which means that we are highly risk. In fact, some of the risk ratings means that we are extremely risky in terms of being able to repay our debt. So it is not surprising that government is pursuing this option of debt exchange to be able to defer some of the interest payments and some amortization so that it gives government the breathing space to be able to meet certain urgent expenditures. Our international reserves, as you see, is 2.9 months, which is a bit lower than what normally is the rule of thumb. At least it should be about 4 months of imports cover, but we are in the 2.9 months, which is not very good. And our fiscal deficit is around 7.4%, which is also higher than what we estimated in the mid-year budget, which was around, I think, 7.2. Still looking at some snapshots of the macroeconomic indicators. Of the indicators that I've shown here, the key performance indicators, we are at risk of not achieving 3 of them. 3 of them, we are almost in the green, light. So if you look at our GDP growth rate, our revised target in the mid-year budget was 3.7%, but estimate for September puts it around 4%, which means that the likelihood of us achieving the growth rate projected for 2022 is quite high. If you look at non-oil growth rates too, revised target is about 4.3%, but estimate as at September is about 5.1%, which is also good for us in terms of economic growth. Inflation, revised target put it around 28.5% as at end of year. However, we are in the region of 40s, which means that it is not likely that we would achieve that estimate, the revised target of 28.5%. And you and I know, how the prices of fuel and all other things, seem to drive inflation over the past few months. Fiscal deficit, revised target of about 6.6%, and as at September, we are 7.4%. So the likelihood is that we will not be able to achieve that deficit. That's the difference between our revenue and expenditure, how huge it is as a percentage of our GDP. In terms of primary balance, it seems to be quite good. I mean, we seem to be in the region of 2%, primary balance. I mean, which seems to suggest that this particular indicator is also in the green light. It means that it is likely that we're going to achieve that target. The last one, which is the import cover, which we are around 2.9 months, which is lower than the 3.5 targets that we revised during the mid-year budget presentation. So in essence, we've achieved almost 50% of the targets, or we are likely to achieve 50% of the targets set for the key macroeconomic indicators, and then the rest are likely not to be achieved given the circumstances that we find ourselves. So this picture that we've painted tells us a lot about the need for government to secure an IMF deal. I mean, it is essential and critical, but we know that there are certain prerequisites for government to be able to achieve or to close that deal, which would help us to achieve policy credibility, which will help us to bring in some needed foreign inflows into the economy, and also help us to be able to stabilize and to ensure that we realign certain key government policies that will enable us to drive towards the macroeconomic stability that we want, and in the targets that we've set for ourselves in 2023. So we know that with the IMF, they would always come back with certain key performance criteria. I mean, what they call them quantitative metrics. And some of these indicators will be part of it. For instance, a fiscal deficit of probably not more than 5%. I mean, for that, it will be a condition for us to be able to drive towards that. So for the next few years, there will be quite austere measures that government would have to take to be able to bring down our expenditure and to reduce the fiscal deficit to manageable levels. Now, what are the targets for 2023? 2023, we're looking at an overall GDP growth of 2.8%, and this is quite low compared to the growth we've experienced from 2017 to 2019, where we're in the average of 7% growth rates. If you compare this 2.8% to even the overall West Africa growth, which is projected to be over 3%, it means that we'll be growing lower than what the average for the West Africa sub-region is, which tells us that there will be challenging period for the coming year. Non-oil growth is about 3%. Fiscal deficit is estimated to be 7.7% of GDP. So if you look at the colors below, Our revenue target is about 143.9 billion. We are going to expend 205 billion. So the difference is the deficit, which is the 61.48 billion. If you express this as a percentage of our GDP, then we are around 7.7%. Now, the question is, how will government finance this 61.48 billion? That is the gap between revenue and expenditure. It would definitely have to come through some form of borrowings. So either domestic and then external, and we don't know how successful this will be, given that even what has been given to government in terms of debts that it already has in the domestic environment is going to be restructured. Then how would government finance this 61 billion with additional borrowing? So these are questions that we need to address our minds to, that yes, it is going to be quite a difficult challenge for government to finance this deficit that is is facing it at this moment. Inflation end of December, we're estimating will be around 18.9%. Still in the double digits, as at December 2023, we are projecting it will be 18.9. That is coming down from the 40 region to about 18.9%. That will require quite some very difficult measures to be taken. Import cover of about 3.3%, and then primary balance or surplus of 0.7% by 2023. So these are quite ambitious targets that government has set for itself going forward, and how government is going to achieve these targets would depend on quite a number of measures, which Dr. Osae earlier on mentioned quite a number of them. My job is to then look at some of the key anchors that government is really betting on to be able to achieve some of the targets that have been set for itself. So there are 7 key pillars that government is hoping to use to be able to rake in the revenue, because our major problem is the deficit. I mean, that is giving us a lot of headaches, because out of the expenditure of government projected for 2023, interest payments alone make about 52 billion. So of the 205 billion, government is projecting that 2023 it is going to pay 52 billion interest. Wages and or compensation to workers is in the 40s, about 41, 42 billion. So when you put the two together, it is almost 100 billion. So the payment of interest and compensation to workers make up half of the expenditure that government is projecting for 2023. Before we talk about other statutory transfers, we talk about investments into infrastructure, we talk about other expenditures that government needs to meet. I mean, whether we like it or not, all the flagship programs that government is pursuing, the 1D, 1F, the free school, the school feeding and all that, all need to be financed. And if interest and compensation make up 50% of that expenditure or that revenue, then you are in a deep hole that we need to find ourselves as to how we get out of that hole. So domestic revenue mobilization, and I think Michael will present on the tax environment and how government is going to mobilize revenue to be able to achieve the 143 billion that it is projecting. Then streamlining and rationalizing expenditures. This is also one area government is looking at. And it is critical to note that, I mean, last year, if expenditure was around 130, 140 billion, and we are projecting that 2023 expenditure will be 205 billion. With all these rationalized expenditures, and government is still projecting 205 billion, then it means that really, if government hadn't rationalized some of these expenditure items, then it means our expenditure would have been in the excess of 230, 240 billion for 2023. So there is quite a huge gap between the inflows and outflows that government has to bridge. The third is the local production capacity, which we need to build, and what opportunities they present to government, to the private sector. Then the fourth is to promote and diversify exports. The fifth is to protect the poor and the vulnerable. The sixth is to expand digital and climate responsive physical infrastructure. And then finally, to implement structural and public sector reforms. Now, of all these 7, I mean, we can prioritize them and see as to directors of our companies, which ones do we think we need to really refocus and to develop specific strategies to take advantage of them. So for example, I'll give for the promote and diversify exports. Today, we process just 50% or so of our cocoa beans and we export the rest in the raw form. It is estimated that the entire chocolate value chain, I mean, is in the trillions of dollars, about $15 trillion. And we leave that for the developed world to take advantage of the cocoa value chain. Whilst we only scramble for just the $2 billion that we bring in during the cocoa season. So this year, for instance, we got about 1.3 billion, whilst we used to do 2 billion. But the critical value is at the end of the value chain. That is when we have chocolate. Can we reposition ourselves as a country? How do private sector players take advantage of this huge market in the chocolate industry and go into processing rather than just leave government to export almost 50 to 60% of our beans in a raw form to the outside world? Now, let's look at things like fund digital and climate responsive fiscal infrastructure. How do we take advantage of that in terms of expanding infrastructure in this country? Now, to my last slide, which I'm going to highlight the key opportunities and challenges. I put them into three main buckets. The first one, I would say fiscal impact. The second one is the value addition, and the third one is sustainability and infrastructure. So what do I mean by fiscal impact? So number one, we know from the budget that government is going to introduce a number of tax measures, which we'll go into it shortly by the next speaker. Now, companies or directors need to ask themselves that, okay, with these new tax measures, how do we recalibrate to be compliant? How would this affect our pricing mechanism? How would it affect our cost of production? And how are we going to add it to, the cost to increase price? How elastic would the demand for our products be such that should we increase our products because of the increases in taxes, how would customers respond to it? So it is something that directors would have to do to help their companies to assess the impact of these new tax measures and this review and realignment of tax incentives. Some incentives are going to go away. How would they impact us? How would they impact our bottom line? The second point is government's going to borrow to finance that deficit of about 61 billion. Now, what it means is that government is still going to go crowd out private sector in the finance space, in the capital markets. How would government be able to bridge that gap? Would definitely be through borrowing, which means that cost of capital is essentially going to go up. The question is, the fact that government is even restructuring what is in existence now, would fund managers and other investors be willing to give money to government in 2023 because what already has been given to government, paying it is becoming a challenge. The third point is the fact that with this debt exchange program, we need to assess our level of exposure. So companies need to assess how exposed they are to this exchange and then do the analysis to see what the impact will be. We foresee that there could be some huge impairments for certain institutions, especially the banks. They need to assess it and see how they have to write off maybe some of the income or some of the assets that they are unable to recover. So it will have a hit on the company's bottom line, and companies need to do that and reassess what the impact will be. We need to do maturity matching. So if we borrowed and then we have lent it to government, how does it match? If there is the need for us to repay our depositors, to repay those that we took funds from, how do we do that when government is going to restructure the repayment such that we are not going to get the money in 2023, but probably will be deferred to 2024, 2025 thereafter. So these are things that we need to address our minds to in terms of the challenges and risk from the fiscal side of the budget. The second one is the value addition component. How does the budget present opportunities for us as businesses? And I've given just a few examples here. Number one, which Dr. Osae mentioned earlier, is the opportunities in the agribusiness sector and local production. So Bank of Ghana is not financing the imports of certain key commodities, which means that we need to look locally. How are we going to take advantage of the production of rice, maize, soya, poultry, and these are key ingredients into poultry feed? How do we take advantage of that as companies to be able to build capacity and then go into local production, especially when the Development Bank Ghana is going to help with the financing? The second sector is the automotive sector. Government has developed a whole policy on component manufacturing, and it's also in the process of developing a development center for automotive. Now, the question is, how do we position ourselves? If you look at a company like Newplan, it has the capacity to put together buses in excess of about 100 a year. Now, government imports over 200 buses a year. How can we position a company like that so that we reduce the pressure on Forex in importing buses from elsewhere? How do we revamp our automotive industry so that we supply buses to companies like the Metromas, the Ayalolo, and the STC so that we reduce the importation of buses? And then the final bit is the value addition in terms of seeking market access beyond Ghana through the free continental trade. I mean, businesses need to be agile. We need to be competitive. We need to look at our standards and see how we can be competitive on the international market to be able to export. I mean, if we look locally alone, the market is constrained. How do we extend our market reach, our market access, so that we are in a situation where we can diversify? It's the same products that we are looking for a new market. We already have the product, but how do we enhance the standard such that we can be competitive? We need to be agile. We need to look at digitizing our processes so that we can reduce costs and therefore become competitive if we want to take advantage of the value addition. And then finally, is the sustainability part of it. This is something that is really not so much on the agenda of many companies. That is the ESG agenda, the environment, social, and governance. I mean, with a recently held COP, we know that a lot of funding is going to go into environmentally friendly initiatives. How do companies then develop sustainable projects that are in line with ESG objectives that will attract financing? Today, getting conventional financing is going to be expensive. Government is even not having access to the international capital market. So a private company having access to financing from the conventional market, commercial lending, will be quite challenging and expensive. And therefore, we need to then recalibrate and ask ourselves, how do we re-strategize and develop sustainable projects that will attract sustainable financing sources? And even government would have to look at sustainable financing sources, like looking at SDG bonds, looking at green finance, to be able to finance a lot of the projects that we are doing. The second one under that is the road infrastructure. We know that the 2.5% increase in VAT is geared towards financing our road. How do construction companies position themselves to be able to take advantage of this infrastructural projects that government is putting together? And then finally, it's the PPP option. I mean, with the government not having access to international markets to raise money to finance specific capital projects, the option is to go public-private partnership, where the public only creates an enabling environment for the private sector to go raise the funding on the back of maybe some sovereign guarantee or on the back of certain receivables from that project. So the project first needs to be sustainable. It needs to be self-financing, that it will be able to generate financing to revenues to finance whatever money that is being borrowed to pay for it. And so the budget in totality presents a business case and business opportunities for a lot of sectors across the broad sectors. But critical are the agribusiness, the automotive, the infrastructure space, because government is very much interested in expanding our infrastructure, facilities, the road infrastructure, railways, health, and many others. How do we position ourselves to take advantage of that? And it will require a lot of strategic thinking and looking at sustainable ways by which we as directors can help our companies to take advantage of these opportunities. So this brings to my end my presentation. I'm hoping that during the Q&A sections, we can all discuss and then have an interactive session there. Thank you very much, Dr. Boateng. Over to you.
Thank you very much, Mr. Evans Asare, Associate Director, KPMG. You've really done a great job on the strategic implications of business and the opportunities that is there for businesses to explore. I will move on to, that will be the final presentation, and we'll zoom into the panel discussion. And here we are looking at the proposed tax measures and their implications for decision-making. And our focus is on the corporate director. And we will call on Mr. Michael Boateng, who is also an associate director at KPMG, to do us the honors. So Mr. Boateng, my namesake, you have the floor, sir. 20 minutes, sir. Mr. Michael Boateng.
Yes, can you hear me?
Yes, we can hear, but I think your screen, okay, good. We can see your screen now.
Okay, thank you very much. So just to follow up from where my colleague actually ended, and I think also where the Dr. Osae actually indicated, I think as board members and also professional director, I think this is a very interesting time, especially looking at what the government intends to do in terms of the measures that is trying to implement in terms of domestic revenue mobilization. And I think it's quite interesting, especially your role as governance, you know, as make sure that governance of entities that you are actually working in, actually those governance issues are actually, being upheld. And I think that's where tax compliance and how you navigate the process becomes very key. Now, this year, I think 2023 is going to be a very interesting year. I think as a tax professional, for me to see a tax revenue ratio from 30% to 18% is very, very ambitious. And I think if you go through the number of proposals, I think you begin to see how, as directors, you begin to navigate through. Now, if you look at the tax measures, one of the key ones actually is about the PAYE. When we say the PAYE, we are talking about the employment or individual taxes. Currently, we have the maximum being 30%, so that those who are earning around 20,000 Ghana cedis per month, your salaries are taxed as the highest band at 30%. Now, the government in this quest, to increase the taxes or revenue is now looking at 35%. The question that we are going to ask is, at what brand are you looking at? Are you now going to increase it from 20,000 per month to, let's say, 30,000? So these are all discussions that definitely will come up. But I think from where you see it, that's another way of where the government is trying to increase their revenue from a domestic perspective. Then there's also another element, which is the vehicle aspect of our individual taxes. So currently, when you have you are being given certain benefit in kind as part of your employment, you actually, for instance, if it's vehicle, you pay around 5% of your total cash emolument, and it caps it. Basically, the government, all the time past are trying to cushion employees, if you are giving those benefits so that you reduce your taxes. Now, the understanding is that they intend to increase this limit. So what this means is that there's a possibility that you look at it, which will be in line with the inflation because of high cost of living. So that this is another way where we are going to see certain aspects of benefits or taxes being generated. Then also there's also the introduction of the withholding tax when it comes to individuals, when the individuals actually realizes property. So in this case, when you are going to see what currently when capital assets and others are actually realized,
they are considered as part of your normal income taxes and then tax as such. However, based on the discussions that and then also the intent with government, the idea is that look, we are losing some, we are not able to track this. So they are going to actually introduce a withholding tax so that those who are actually going to buy or who are going to make payments when these assets are actually being sold or disposed of, then the withholding tax actually comes in, so that in that way the government is more assured that if the person who actually realized this taxable income is not tracked, at least the person who actually bought them, who made the payment, then it becomes your responsibility to make sure that when you are paying for anything, any of these assets, you are actually making sure that you are applying the withholding tax. And now it goes back to the point of the role of directors. Now with this, as directors and professional and board members, now from a governance perspective, these are areas that you need to look out for, so that you make sure that in this, the government's quest in increasing the revenue, you're also protecting the governance process and also the image of the organization that you are working for. Another option, another proposal that the government is also having is actually looking at the 15% rate for individuals when it comes to assets. So here we are looking at, currently we have 15% when individuals actually sell assets, but now based on the government's I think goals of increasing taxes, this is possibly going to see an upward increment, which definitely will see more taxes from an individual perspective. Then there's also another interesting proposal where the government is now going to increase certain concessional taxes that it has been given to certain industries, especially those in agro processing, agro farming, and others. Currently, a lot of them more or less were taxed at 1%. Now the government said, look, now to share the burden, we are now going to increase it to 5%. Now this is quite going to be an interesting point, because what we are going to see is that now you are going to see a lot of people coming up and say, look, we were having these taxes concession rates basically because of the industry within which you're operating. But now you are saying, look, we all need to share the burden. So moving it to 5% definitely may see some backlash. But as directors, we may also have to look at for this area. And another interesting proposal, which I think is also going to be interesting, is the minimum chargeable income. This is something that has been on discussions, so many discussions, but now it's actually been introduced. So what does it mean? Now the government is going to come and say, look, and it depends on how the final proposal, the final tax would be. If you make certain either losses or if you make certain revenue, the government is going to say, look, there should be a minimum chargeable income, and the devil is in the details. So definitely this will come out. Now, what this means is that it could be even startups, it could even be companies and others who may not be making, or those who are making losses. The government is saying that, look, where we are, we need to share the burden, and therefore we need to make sure that whatever level that you are, you need to come out, you are going to pay some level of taxes, and you cannot go beyond that level that will be agreed. And I think we should all be looking out for what the final this will come from the which will be translated into the tax laws. Then also we are going to see another increase in taxes for a lot of companies. So currently, the government, we have the National Fiscal Stabilization Levy, and this levy is actually have been targeted to certain industries, especially those in the mining, mining support, certain industries like the financial sector and others. Now the government is saying, look, now I'm going to expand this. What we have now is around they are actually paying 5% profit before tax as part of this levy. Now the government in this quest to increase the taxes is saying, look, now I'm going to spread it to almost all companies. So what are we doing? So now we are going to see it being turned from National Fiscal Stabilization Levy into Growth and Sustainability Levy. And this will cover all sectors. So what you are going to see that you have about 3 categories. You have category A, B, and C. Those in A, which more or less are those who are under the National Fiscal Stabilization Levy, are going to see 5% be maintained, and definitely we are going to see additional 6 sectors. Then those in this category B, which comprise of those all other companies, except those in the extractive industry, are going to have 2.5%. That's actually will actually hit a lot of companies. And then we have those in category C, which comprise of those actually in the extractive sectors, who are going to now have this level of 1% of their production. So this is quite going to be interesting, and it's going to be one aggressive way of actually increasing taxes. And I think as directors, when we have one day the final act, our law has actually been implemented, from a compliance and also from a governance perspective, this become one of the key interests to make sure that from a compliance and governance perspective, this is actually looked at for. Another interesting proposal, which I think is a very good point, is a very good thing for businesses, is how now losses are going to be carried over. Currently, companies that make losses, the average, the normal companies or average companies tend to have around 3 years. And those in specific industries, in mining and other companies, they have 5 years. But to streamline the process and to make sure that this benefit is also shared across. Now the government is trying to have more or less a unified approach to this, so that if it's going to be 5 years, then all companies, whether we be you in whatever industry, we are going to enjoy this. So, and this is a benefit that in the midst of all the proposals which are likely to increase taxes, this is something that we need to look out for as directors, that to make sure that from a compliance and process point of view, these benefits are actually being taken care of. Another proposal which is going to come is also from the foreign exchange losses. So what does it mean? Now, currently, if you look at the Income Tax Act, forex losses that companies actually may incur, what happens is that when you incur these losses, there are actually provisions where you can take them, and they are very lenient, more or less. There is a limit, but then from a financial point of view, but then you still don't need to show that you have realized those losses, and you can carry them. You can take the tax deduction for that. Now, with this new proposal, there is going to be a more or less a strict compliance. What does it mean? Instead of you to show that you have actually incurred the loss, they want to say that you have actually realized it. So this means that now, with what we have with a lot of companies incurring a lot of foreign exchange losses, now you cannot just take the tax deduction just as it is because you have incurred them. You really need to show that they have realized. And this was actually in line with what the previous Income Tax Act, 592 had. But now, when you move into the current income tax, to make it more lenient and also beneficial to businesses, it was changed that as long as you incur the losses, you can take them. But now they are going back to the previous law, which makes it difficult to take advantage of this. So basically, they are deferring you taking the losses, but they want to make sure that you've actually realized them. I think that is one thing that we are, as companies or as directors, you may also have to look out for. Then also, we are expecting to see some reforms to the taxation of those in the gaming industry. Currently, there have been a lot of interpretations of how they are being taxed, especially from a VAT point of view, and then also from the income tax point of view. Now we are going to have more or less, they are going to be taxed from a gross perspective. That's the gross gaming revenue will be looked at from a taxation point of view. So that is something that we are going to see how to be rolled out. This is something that other jurisdictions are actually having, got to avoid the complexity for those in the game industry. So when we have that uniform, I think it's something that we need to look out for. Then also the winnings, so that they're going to be withholding tax on those who win, who make winnings from gaming. So in this case, now companies who are within this industry will have to make sure that this withholding tax regime is actually being applied when you are making payments for winnings. Then also another good proposal is also actually the waiver of taxes when you are withdrawing from your tier 3 fund and other more or less for pension, from a pension schemes. So what we are seeing is that currently, if you are actually withdrawing money from your tier 3, it's actually being taxed, because, and especially if you don't let the time limit pass. But now they are going to waive those taxes so that individuals can go ahead and withdraw money from their tier 3 funds and then these taxes will be waived. And then one interesting tax will be on the vehicle taxes. So here we are going to look at what we have. The government is going to increase it because they understand that these taxes are actually on very much low, and with all the increase in cost of doing business, and also the government's quest to increase taxes, we are going to see the vehicle income tax has actually been increased. Another interesting point which we are actually seeing, and I know this has been a talk, is also this the expectation that the VAT is going to be increased by 2.5%, from 12.5 to 15%. What this is going to do is that it's definitely going to increase more or less the prices. But then the question then becomes, how does businesses become competitive when their consumers or their customers are going to see increment in the taxes that they are going to pay? But then it comes back to the 2 points. One, the government's quest to increase revenue. And then two, you are going to see that you want to be competitive. So these are the discussion that you're going to have. Remember when this proposal, is being discussed, one of the key things that because of the time limit that the government has actually to raise the revenue, the other areas of increasing the pie and those things becomes very difficult. So now it's easier to increase the revenues, the taxes now, and then try and see how best you can roll the others. But I think the question then becomes, how does government, how the business become sustainable with this environment? So I think this is something that we all have to be looking out for. And then also now the government is also trying to increase the threshold for companies that are actually supposed to be registered for VAT. So currently we are looking at 200,000 per annum as your revenue. However, because of the cost of doing business, inflation and others, we are now going to see that the government is saying, look, let's move it up so that at least we can give a breather to those who are actually on the lowest, lower line of businesses in terms of revenue. Then also we are going to see the government trying to propose the e-levy, that is from reducing it from 1.5% to 1%. Here the understanding is that they want to reduce it, but then you could see the whole idea is that now they are going to see more revenues being generated from e-levy. Now they intend to scrap the exemptions, and now it's going to affect all businesses. So that is something that we are likely to see, even though the exemptions might have helped certain businesses, but this may lead to more or less cost or increase in cost of doing business to some extent. Then also one interesting point which has been hammered over and over, and that is the exemption of VAT. Currently, there are a lot of discussions on the exemptions of VAT from certain transactions or businesses or regimes. And I think the whole idea is that, look, we are now going to relook at it and say that, okay, how do we streamline this exemption regime so that we get more revenue from that? Because there have been a lot of discussions and reports coming as that, look, the government is losing a lot of revenue from the tax exemption process that we have. So we are all waiting to see how the government intends to come up with this whole exemption regime streamline, which we are going to see. And I think the interesting point, the next one, is the rolling out of the EVAT. Actually, the EVAT, if you look at it, we even had a discussion on it yesterday at the GRA event. What the GRA is, all the GRA is trying to do is, look, most of these businesses, especially those in the large tax businesses, they actually collect this VAT on their behalf, and they are not able to account for them properly. So the government is saying, look, I want you to go through this process or this system, this platform, so that we can track how much VAT you are collecting, so that you can report this to us. I know this became a controversial project, but if you take if you take a step back, and as a tax professional, we the consumers or users of goods and services actually pay for VAT. Therefore, the question is, when these business collect our VAT, do you make sure that they remit them to the government? I think that is what the government is trying to do by rolling out the EVAT, to make sure that now businesses, when you collect the taxes that your clients or your consumers or your customers have paid to you, they make sure that you are paying to me the right amount. And it's quite interesting that in recent discussions, even the pilot that has been done, the GRA has shown that they've actually doubled or tripled the number of the VAT that they were collecting from certain companies. Another measure that we are likely to see in 2022 is 2023 is the streamlining of the HS code. I think this is to make sure that it's uniform within the region, especially to make sure that when it comes to custom duties and others, evaluation of items, all these things are streamlined within the region. And this is more or less to facilitate trading within the West Africa region. Then also we are going to see an upward increment or revision of taxes, especially from the SI duties on tobacco, cigarettes, and others, and also to just make sure that they are also in line with within the ECOWAS protocols. And this actually looking at the SI duties or SI tax on the products such as electronic smoking devices and liquids, which currently are not being captured within the SI taxes regime. Then also we are also going to see the full withdrawal of the existing benchmark. I know this is something that has been discussed, and I know there have been various school of thoughts on this, but we want to see how this whole thing will roll out when the final tax or act actually is passed by Parliament. One area which the government actually, and we hope to see this, out, that is the use of the GRA's resources to work with the various district assemblies to make sure that property taxes are actually properly, collected. So what the government is trying to do is trying to have a uniform common platform, which will be a GRA platform that they will be able to register all properties and make sure that the GRA uses their resources to collect the taxes from various property owners and then share the process with the assemblies. And I think this is an area that a lot of stakeholders have complained that we need to make sure that we expand the tax net and to make sure that taxes are the tax burden is fairly shared. Then we are also going to see the reintroduction of the road tolls in 2023. So definitely this is also all in line with the government's quest to increase its revenue. But then the idea is that they intend to use technology, rely on technology to make sure that these they are going to reduce leakages and then in the inefficiency in the previous collection process. Then we're also going to see the revenue assurance. This is something that we've been having with GRA, has been there, but then I think they want to make sure that they move it more in terms of the import of goods to make sure that at least there are more or less review the collection of taxes and others, and review of the assurance compliance is in line to make sure that the leakages which we have been seeing are actually being addressed. Then also another important thing is the review of the exemption regime, because currently we see that there's an act being passed, but then the process of implementing that is actually being finalized. And the whole thing is that there are so many leakages moving away, leakages in the revenue collection based on how tax exemptions are granted to certain individuals and organizations, which we expect that when the guidelines and the procedures are actually rolled out, definitely all these leakages definitely will be looked at. And this actually forms part of the review of the waivers and exemptions. But then one interesting thing which the government intends to have, and which I think may have challenges, is also the review of the waiver for I don't want to say foreign companies, because those operating the free zones are actually Ghanaian companies, but their main intent is to increase export. For the first 10 years, they are exempt from tax, corporate income tax. Now the government is trying to have this reviewed and make sure that at least they pay some level of taxes, which now we are going to see how this is going to grow that, because I know there will be a lot of pushback. Then also we're looking at the review of the exemptions for more or less those mining companies and others who actually have specific fiscal stability agreements. And this is something that a lot of stakeholders have raised concern that this may have legal implications that the government will face. But I think we all have to wait and see how this whole thing will roll out. We also expected to see the self-clearing of goods by importers to make sure that they are taking advantage of the new process that the GRA is actually trying to have actually implemented. Then also the government is also looking at additional oil entitlements to make sure that it's actually getting as much revenue from its more or less the resources that we have. Then lastly, we also looking at the rent tax. And we all know that a lot of leakages have been going on in terms of rent taxes. So the government is also trying to come up with mechanisms to make sure that it's actually getting its fair share from income that can be taxed in the form of the rent tax. So thank you all. And I think definitely if you have any question during the panel discussions, those things can be addressed. And thank you for your time.
I mean, thank you very much, Mr. Michael Boateng, an associate director at KPMG. He has given it all to us. And it's obvious that with GRA coming up with their 10, pillar, we as directors must be mindful that technology is now going to be key. So we should make space for investment in technology. So more CapEx, for us. I think we are now going to move into our boardroom discussions, and I am going to call on Mr. Andy Akoto to join us. He's a partner and head of advisory at KPMG. So I will invite Mr. Andy Akoto to activate his camera. I will invite Mr. Michael Boateng to activate his camera. And I will invite Mr. Evans Asare to activate his camera. And Dr. Oduro Osae, you can also activate your camera so we can zoom into the discussions. Are we all ready? Okay, thank you very much. I am missing Michael. Michael, we want to see you. Okay, somebody should prompt Michael that we need, him here. Dr. Oduro, are you still on? All right, okay. So I think we've had a number of presentations, from all angles. And I just want us to narrow this down to how the director will be able to navigate, around everything that, we have discussed. And I'm going to start from the risk perspective, and I want Evans to take this up for me. So, Evans, with your presentation, and from what Dr. Oduro indicated, there is all indication that government need to raise more revenue. And the focus this time is going to be on domestic revenue, mobilization. Now, let's look at the debt exchange, which we are all discussing. What is the implication of this debt exchange on businesses and the role of the corporate director? When we get to the boardroom, what should we think? How should we navigate around this? So, we'll be able to sail our companies to the directions that it's supposed to go.
Thank you, Dr. Boateng. I hope you can hear me.
Yes.
So thank you. So I think the critical issue here is the question of what is the alternative to debt exchange. There's a risk there of default that, okay, if we don't have this debt exchange, it is likely government will not be able to meet those obligations. So board directors have to be asking themselves that without the exchange, the alternative probably might not be what we desire. Now, if the option is to go for the debt exchange, which is to say that we are deferring payments of the interest, okay, and we are probably reducing the coupon payments, okay. So from what government has put out, it's 0% for 2023, I think 5% for 2024, and then I think 15% or so for the rest of the years. If that is the case, it means that the coupon rates have been slashed, okay. There is not much talk about the principal. The belief is that the principal is probably guaranteed that at the end of 2027 or 2037, you get your principal. So then directors have to be asking themselves that, okay, with this debt exchange, how is it going to impact our commitments and our obligations? So if you are, for instance, a financial institution that you have taken depositors' money and you've used it to buy government bonds, it will fall due for you to meet those depositors' demands. How do you meet that? So there has to be some kind of a maturity matching. That's what I call it, so that you ask yourself, how do you meet your obligations? Because the one who is supposed to meet his obligation is also deferring that. So that needs to be done to be able to make sure that we match those maturities. And then we also need to look at internally our operations and see how best we can save cash. At this stage, it's about how to conserve cash, because we need to look at ways to generate enough to be able to meet certain obligations that may fall due. And so the debt exchange program may not be a desirable option for now, but one would want to ask, without it, what is the risk and what is the alternative, really? So those are my views on the debt exchange program. Thank you.
Thank you. So it looks like we don't have many options at this stage. So we should brace up, you know, as directors and be able to navigate through these difficult times. Andy, sure. I'm coming to you from advisory point. Now the question is, there has to be more of domestic revenue mobilization. We are talking about haircuts. We are talking about mark to market, even to the point that I have a young person who decided to invest, you know, some amount of money, and he decided to go to redeem, you know, his money. He is not even getting his principal. And this is a very young person who, you know, we are encouraging to inculcate the ideals of savings and investment. Now, from advisory point of view, what do you think this will impact on individuals from the micro level who, you know, intend to invest? And then if we aggregate this to the organizational level, what should businesses do? But first, I want you to bring us to the understanding and how this will affect individuals, their savings mindset and that culture, and then to corporate organizations.
Okay, thank you, Dr. Boateng. And it's evident that we are all in very unusual but difficult times. And like you have intimated, a lot of people are still trying to process, you know, how the whole debt exchange restructuring exercise is going to impact them. Myself not included, not excluded, because just last night I was talking to a colleague of mine who was already calculating how much he stands to lose from this whole arrangement. That is, if he looks at it from the viewpoint of one, the possible adjustments to returns from the investments he made, and also inflationary impacts. Then, of course, he's looking at, you know, some losses in the short to medium term. And that's a reality for every individual. And therefore, it calls back to, you know, grappling with the basics of financial management 101 to make sure that we all tighten our belts and look at ways to manage our finances in such a way that, more importantly, we don't feel the liquidity squeeze, because it's a known fact that any finance professional will tell you to
try and diversify your investment portfolio. And therefore, with all the diverse investment instruments that are available to us, there's a call to actually restructure the way you also go about managing your treasury, both from an individual as well as a corporate perspective. Particularly for corporates, working capital is going to be very, very crucial in the medium to long term. But all in all, I believe, like I intimated, we are all going to have to kind of take the bullet or buy the bullet, because there isn't much escape, especially where the proportion, the significant proportion of your investments are in local bonds. We understand that treasury bills are exempted. So if there are individuals who had invested in treasury bills, then they are kind of insulated. Those who had invested in bonds, the advice would be for them to hold on to maturity rather than attempt to go and immediately cash out. Because if you do that, then of course the mark-to-market regime will impact you. So I believe it's a call for all of us at both individual as well as entity level to get to grips to manage our finances well and ensure that we have adequate liquidity to meet immediate exigencies.
Thank you very much. I will come back to you briefly, but I want Michael to react to this. Michael, the tax band is moving to 35%. Obviously, sometimes when we hear this, because most of the people are not within this bracket, we kind of think, oh, it's an abstract. It's just out of the. But some people are going to suffer in terms of reduction in their real incomes. I mean, as directors, how do we manage this? I mean, obviously, it will be a disincentive, and it will motivate certain staff, within corporate organizations. What are the other alternatives, from tax perspective that we can explore, to kind of compensate for what those who are within this tax bracket, would have lost?
Thank you, and that is a very, very, very interesting point. Now, if you look at where we sit, I think from a government point of view, the whole idea is that those who make more money should contribute more. They should share the burden. So you could see that it's more from a progressive point of view. They say that the more you earn, the more you have to pay taxes. And I think that is where they are looking at it. Now, from a tax planning point of view, and I think I'm very, and I will use these words very, very carefully and very, very useful. I think very carefully, and that is, as directors, I think your role as the keeper of governance and those things become key. Now, what are the benefits? What are some of the things that you can manage within the law to make sure that you are not paying undue taxes? So here is where, if you look at a typical corporate individual income tax, there are certain benefits. So then how do we then streamline certain benefits to be in form of in-kind? So for instance, you're looking at whether instead of giving cash, you have to be giving it vehicle, whether it's vehicle and then also vehicle and vehicle and driver, vehicle and fuel. All those things are things that you need to explore. You also have to look at certain benefits in terms of contribution to more or less tier 3. I know that we are having challenges with haircut and all those things, but then the question then becomes, there are benefits that if you make pre-tax contribution, those taxes are actually waived, and therefore these are so. I think that there are so many. Even though in Ghana we don't have as many as when you look at other countries, but there are certain ways that you can look at it, and that's where, as directors, you may have to take a step back and ask yourself, okay, I need to get someone to walk me through how do I structure my salary or my contract to make sure that I'm not unduly paying the taxes, even though you want to make sure that you are contributing your share as a corporate citizen, but make sure that you do it in legally or in the right manner. Thank you.
Thank you. So, directors, I think we've actually moved to the age that we really need to take advantage of expert advice. so we don't be on the losing side. Andy, I'm coming back to you. From the presentations we have taken so far, it's obvious that as directors, we have to navigate the positives, and then we should spot opportunities. Again, we are also supposed to identify low-hanging fruits and make sure we take advantage of them. Mostly, these things bring associated risks. I mean, can you walk us through from advisory point of view, what are some of the risks that directors should look out for and how we can deal with them?
Okay, thank you for that question again, Dr. Boateng. So let me start by situating it in the context of the global economy, because the KPMG survey for 2022 of top CEOs actually points to the fact that about 85% of global CEOs expect some sort of recession in the next 12 months to 1 year, obviously. And that therefore means a call to some austerity and therefore the need to ensure that we still, as you have intimated, find ways to still look for opportunities, even in the midst of the challenges that are anticipated. Indeed, from all the earlier presentations that came through in the morning, it's evident that it's a call for directors in their oversight role to ensure that they lead organizations to recalibrate their strategies. Doing nothing is not an option, okay? And anyone who also believes that their strategies, even crafted a few months ago, will still be good for today, will probably be complacent. And therefore, the advice to directors is to switch immediately into an agility mode to be able to respond to both challenges as well as opportunities that the current economic environment presents, has to be able to be agile and to be able to respond both negative as well as positive opportunities, if I can put it that way. And for the Institute of Directors, for example, my challenge to the Institute is obviously to also look out for example, the call to public sector reforms and the review of certain state institutions, because we all know that it is when the governance in these institutions go in the right direction that the economy as a whole also gets strengthened, and we get the benefits from investments that the government make from these state institutions. So my call will be for the Institute of Directors to not be a side participant, but probably to also look at situating the need to drive corporate governance reforms, not only through public sector, but the private sector. Indeed, so conversations with actors in the SMEs, industrial zones, indicates that they've made available funding over the last few years. The question, though, is whether the funding, is yielding the right returns if commensurate investment in the capacity of these SMEs to up their game in terms of building strong governance, risk management, and control systems don't go alongside. But just to also round off on the question you posed, clearly there is no opportunity without risk. And therefore, if we take a risk-based approach, again, there was a call to embrace some sort of enterprise risk management. In simple terms, all it means is that we try and take a risk-based approach, even to looking for opportunities that we can garner in the current economic environment. And therefore, that means that we look at the entire value chain of our business model and look at those opportunities, but also look at what we need to guard against to make sure that we don't miss out on taking advantage of those opportunities. Thank you.
Sure. Thank you very much. Thank you very much. We really have to take advantage of all the opportunities, and we really need to do that with a full risk-based approach. Evans, I'm coming to you, and before I ask mine, let me indicate to participants here that if you have a question, you can please use the chat box and put your question in. Though we'll be allowing you to ask direct questions as well. So, Mr. Evans Asare, there is a question here from John Owusu in Tiamwa. He's saying that having listened to various discussions on various platforms, I get the impression that the preparation of the 2023 budget did not involve the much needed stakeholder consultations. Now he wants me to ask you, KPMG, were you, as you do always, involved, and did you provided your inputs?
Thank you, Dr. Boateng. So I think we need to understand the context we are in. This year is different. We are not in a normal budgeting cycle, really. I mean, 2023 budget was done in a context where we find ourselves between, the rock and a hard place. I mean, we need to make a choice, okay? And it is a difficult choice. We know that the budgeting process goes through quite a bit more of a bottom-up approach, from the decentralized process with the district assemblies and all that, coming up to the centralized point where it is consolidated into one document. So did the government have enough time to do that broad consultations? I think maybe not, given the fact that the IMF negotiation is ongoing and there needs to be some level of agreement reached to be able to conclude that deal. So broad stakeholder consultation would have been ideal, but I don't think in the current circumstances, government would have that sufficient time to be able to go through that consultations. So for instance, we all know what happened with the e-levy, that when it became critical, government had to do a lot of engagement with stakeholders to get their buy-in, to be able to get it rolled out. I think all in all, it was good, but really the time and then the context that we find ourselves in, the exigencies that we are in, necessitate that we really quickly put together a budget statement that needed parliamentary approval for us to get that credibility, for us to engage the IMF and to secure a deal. So I would think that the bottom-up approach still worked with all input from various agencies, ministries, and departments of government feeding into it. So KPMG, for instance, we usually would do our pre-budget survey and put together a comprehensive report that we normally would take to the Ministry of Finance for them to consider what the private sector is also saying should be considered, when the budget preparation is underway. So that is exactly what we did for this year. And I believed that the Ministry of Finance considered quite a number of suggestions and submissions from corporate Ghana before the budget was put together. But let us really be honest, the ministry did not have time, okay? We know that they need to secure an IMF deal, and therefore this budget process was quite unique and needed to be clinched as quickly as possible. And so I'm not surprised that Parliament has even given approval. I mean, and we heard from the MPs that, learning from the previous budget rejection, it did not make a lot of sense for them to drag this for long, because it really puts us in a very deep hole, and it didn't, require all the brouhaha that happened with the 2022 budget. So, John, Owusu Ntiamwa, this 2023 budget was done in a different environment, and ideally a broader consultation would have been required, but I don't think the government had that time to be able to do that consultation. But I think the minimum consultation process took place and were all considered in forming this particular budget statement. Thank you.
Evans, if I may add to what you have just intimated, clearly there is a need for ongoing stakeholder engagement and consultation. We note that the budget is titled in carbon budgets, and therefore that means unified or a budget of unity. You are not going to get that with the initial pushbacks that we are hearing. And so government is really going to up its game in terms of working with all key stakeholders to ensure that they are able to get the required buy-in on a number of key measures if this budget is going to be successfully implemented. Because what we have is a plan. Executing the plan requires more than just leaving it on paper. It's going to require a lot of engagement, a lot of consultation, probably even some trade-offs and adjustments, especially when the agreement with the IMF, the star level agreement has been reached. It's evident that some aspects of the budget might go through some changes again. And in all this, I think government's engagement and communication machinery must be in the right place to ensure that citizenry and key stakeholders make the most out of the budget. Doc, I think you're on mute. You have to unmute. You are muted.
Thank you very much. Evans, I am coming back to you. Yes, you've indicated that businesses need to take advantage of green opportunities. You did talk about issues of ESG, and in fact, we have just returned from COP27. Clearly, I mean, from advisory and from, KPMG point of view, can you identify some of the green opportunities, within the spheres of our corporate organization, so that directors, will pay more attention to some of these opportunities as, we move forward?
Thank you very much. So we are already in the era of, ESG, where it is becoming the agenda of the day. The first thing directors have to ask themselves is whether they have incorporated ESG in their overall strategic discussions. ESG, we need to understand, is not corporate social responsibility. ESG goes more than just corporate social responsibility. So directors need to first understand what the concept of ESG is. That's environment, social, and governance, okay? And these key elements need to be part of their corporate strategic discussions, that in our business model, how do we incorporate environmental issues, social issues, and governance issues, okay, to be sure that we are meeting these key sustainable development goals. So number one, companies need to set priorities that are aligned to the sustainable development goals, okay? So in our business model, which of the sustainable development goals do we need to prioritize? Is it education? Is it poverty? Is it infrastructure? Is it governance? Okay, is it social justice? Is it reducing hunger? Once we identify these, then we as businesses will then start developing strategies and initiatives to achieve them. So for instance, it will interest you to know that in, for instance, the housing sector, okay, there are technologies that have been developed that help in building green and sustainable housing units that would use solar energy, that will power all the facilities in the building using solar energy without relying on the grid. Okay, so if you are a construction or a real estate company, the question you have to ask yourself is, what are some of the sustainable ways I can put in place to be able to build housing units that meet environmental, requirements? So there are hostels that are being assembled. They just assemble hostels without doing the normal brick and mortar things, okay, that are just put together, and they use solar panels to be able to power facilities in those buildings. Those specific projects are normally, you are able to raise green finance for such projects, okay? And normally some of those financing come with a lot of incentives. For instance, if you are meeting certain key objectives, they reduce your interest rates over the period to a point where even your coupon rate becomes zero. With these difficult challenges, businesses need to look at how we use sustainable financing rather than going the normal conventional way of financing, okay? So within our environment, the energy sector, how do we diversify from these thermal plants into more of renewable energy? That's the question we want to ask ourselves. So as a business, for instance, as KPMG or as any other business, how do we reduce our carbon footprint by reducing reliance on thermal plants or other sources of energy by diversifying into renewable energy? The other thing is waste management. This is a big issue in this country. How do we as an organization create an environment where staff become conscious of how to manage waste? We recently did some work on plastic waste, and it will interest you to know that, look, just being able to segregate waste at the sources, where we put plastics in one box, put organic waste in another box, reduces the risk of recycling those wastes, and that it increases the value of the material that is recycled. In Ghana, we use a lot of virgin materials for plastic materials. So how do we ensure that we segregate waste at the sources as a business to help in the recycling of plastic materials that will feed into the production of plastic materials that are sold on the market? So these are questions that organizations need to ask themselves as to how do we reduce our carbon footprint, and these will be driven from a strategic perspective and not an afterthought that we want to do some CSR activities just to report on that we have done some environmental activity. No, it has to really be driven from a strategic perspective and not from just a corporate social responsibility perspective. All right, thank you.
Thank you very much with that one. And then I think to our colleagues who are driving manufacturing sectors, production and all that, probably maybe, they should move away a bit from linear production, so that there will be more attention to circular economy and all that. I read about Patagonia recently and their reintroduction of circular economy issues into their production. And Patagonia does most of this high-end, winter suits and, all that. And they're actually going to recycle. So you would come in and hire the suit, the jacket, and when you are done, you bring it back, and they would do it as if nobody has actually touched it. All because they want to reduce waste and they want to cut in on the circular, economy. I saw a hand in here. I think you can put it up again, and I will allow you to ask your question. So I will go back and take the panelists' key takeaways to the board of directors. So if you have a question at this stage, you can please put up your hand, use the reaction button, and I will allow you to ask your question. Okay, thank you. Robert Mensah, please, you have the floor.
Thank you very much. I just wanted to us just mentioned, especially on the side of sustainability, and the fact that if you can look at other sustainable businesses, it can help build strong foundations for our businesses. At my end here, we ran a hotel in 2018. We decided to go on the path of sustainability, and we built it as part of our strategy. So we went into a 200 kilowatt system solar installation. This resulted in about 68% reduction in our spend on energy. We decided to have some boreholes and treat the water ourselves and use here. So in our hotel, we don't use Ghana water meter at all. We don't have a Ghana water meter in the hotel. And I'm talking of a 200 bedroom hotel. We did some biodigesters. Previously, if we had to in a month, we would have about the trucks that take the fecal matter, about 20 loads in a month. Now that also stopped because we are using digesters. We decided to go into organic farming, and the fact that even for branding purpose, even people seeing that we are using organic vegetables and those things within the facility, that alone brought us trust. And the result was that, COVID-19, our industry was highly hit. But we realized that our hotel really still maintained its lead in its part in terms of conferencing. And whilst other hotels were having redundancies and laying staff off, we never laid any staff off. We paid everybody, every staff worked throughout the COVID. And by September 2020, we declared ourselves out of COVID because the impact, well, we started now generating 2019 figures. And with what Ivan said, I'm now understanding where this whole story started.
Thank you very much, Robert. And Robert is the general manager of Usbet Hotel in Sunyani, one of IoD promising young directors. He even won a promising young director at IoD. Robert, we thank you for that contribution. So I think these are some of the things, the opportunities, as far as sustainability is concerned, that we could turn our minds on to make sure we are operating very well. So Robert, you can put your hand down. If I can take one more question, so I can go to take the key takeaways from my panelists here, and we would wrap up today's session. Okay, John Ayeyi, please just tell us your organization and go ahead and ask your question, please.
Thank you so much, sir, for the opportunity. I joined in late. I got the correspondent late, but I wanted to get an input of what is going on. And I'm excited so far for what I have heard. I work in the educational space now, a company called SteadyX Limited. We are using technology to leverage on how to take education everywhere, especially the quality of education everywhere, leveraging on technology. So that's what I am into now. And so on the back of this, I want to also ask, how are we using relationships to build sustainable economies? I'm asking because in this space that I'm working in, the educational space, I realized that you can get a quality teacher in Accra to teach quality content in Tamale, and by leveraging on technology. And that alone reduces a lot of cost. Like my brother from Usbet just said, is it possible for even their extra solar that government will not take because they will not pay back to be transferred to maybe a neighboring house that will pay them some subsidy for that? So that's what I am looking at. Can we use relationships to leverage on or to get sustainability going? Thank you, sir, for the opportunity. Thank you.
Thank you very much. I think I will let Andy start with this one.
Interesting question, John. And I would take it more as a proposal than anything else, because to be honest, this whole sustainability journey requires a collaborative approach. And therefore, your call is in the right direction. It's a question of the how. And as you suggest, if we can take a communal approach, but it must be demonstrated by leadership. And I would imagine that if government can take a lead in a number of these initiatives, then it can trickle down to the microeconomy. Evans made a call earlier on for waste segregation. I dare say that in as much as it is so good, and returns will be very, very evident for all of us to see, if government does not put through some policy measure in that direction, it will not happen. Even within our own micro communities, if we decide to do those things, when it gets into the macro context, it will be lost, in translation or conversion, as it were. And so I would say that we continue to advocate and actually hold the government to account to some of their commitments to make our economy a bit more green. Because if we do that, then of course the benefits as espoused by Robert and others will be there for all of us to see and for all of us to gain. And invariably, for me, as a consultant, I have worked with a number of international partners in doing some studies that point to a real dividend, in going on this sustainability trail, because the call for clean energy is very, very loud. Okay, and for example, I know, for example, that the Energy Commission is experimenting with putting in place, for example, electronic vehicles regime. But at the same time, we have an automobile industry that is calling for assembly plants based on fossil fuel technology. And so if government can begin to shape that discourse and that conversation towards more environmentally friendly vehicles, for example, maybe Ghana can break the ground and get a first mover advantage to distinguish itself from the rest of other car manufacturing or assembly hubs in the region, and play a more active role in taking our sustainability program to the next level. Thank you.
Thank you very much, Mr. Andy Akoto. Evans, will you want to add something to the relationship approach?
I think Andy has said it all.
Sure,
I mean,
sure.
we work with a Chinese clients that wanted to do e-learning by building some a bit more complex, system where tertiary institutions will leverage. And I think the critical challenge was, having fiber connection across the country. And it will require, if it's a relationship, how we get the governments to work with the telecommunications companies to be able to extend, access to internet, across the country. And that's program that they were introducing was going to give access to tertiary education wherever that you are in this country, only if you have access to internet. And so the challenge, the critical is the infrastructure. How do we get infrastructure to all these communities to be able to make sure that they have access to education, and proper content, so that the lecturer can be in Accra, you can be in WA or whatever, and then you still have access to that quality tuition that is required. So I think, that's all that I would probably add to what Andy said earlier. Thank you.
Thank you. Robert, do you have a follow-up question?
No, just on what he asked about sharing and then within the community. And I just wanted to give an example of what we've done. So we also, next to us is a KFC. They are on our property, and it's an agreement that we had with them. So for every sale that is made, we make a certain margin of it. And we had an agreement with them that we were supposed to provide generator and all those things as part of the deal. We said that, look, we have a solar system. We can generate more and send you some. And when the solar is not working, we are using grid tie. So we only no batteries. The cost of solar triples as soon as you bring in batteries. So daytime, right now I just checked, we are even currently exporting just a little to the national grid. So we discussed with them that, look, we will provide you with that. And when in the night, if the national grid goes off, we have enough capacity on our generator to also give you some. So we let the pipes, the lines to their property. And that's what we do with them. We provide them with water, we provide them with electricity. At the end of the month, we give them a bill. And that bill counts now to reduce my cost of operations. Thank you.
Thank you very much. I mean, Robert, you guys are really exploring green technologies and doing so well with your operations. We appreciate. Michael, you've been quiet for too long. Let me come to you. Michael, when you talked about the loss carryover for 5 years, you sounded more exciting, and it looks more like this is very good for businesses, right?
Correct.
Yes, board of directors want to really understand. We are not interested in running losses, so we carry it forward. So what is in this for us? Thank you.
Okay, thank you, Dr. Boateng. So basically, let me give you a scenario. So let's say company A in operates in the industry. Now, in year one, company A made a tax loss of 100,000. So in that year, year one, company A didn't make any taxable, made the loss. All things being equal, you would have said that in year two, when company A is operating, it's running on a clean sheet, so that you begin to look at its revenue, look at expenses, see how much taxes you owe for the year, and then pay the appropriate taxes. What the laws carry forward is saying that, look, company A, I know that company in year one, you made a loss, a tax loss of 100,000. Now I'm going to give you the opportunity that take this loss and reduce your year two possible income taxes that you may owe, reduce it by that 100,000. So this is a very a tax planning, a tax benefit to companies. So in this case, when we are saying that the 5-year rule, currently most companies are on the 3-year rule. So you can carry this 100,000 in year one. By year 3, if you have not been able to utilize this, then it will expire. That is year 3 in the current regime. But now, if you move to 5 years, that means that the 100,000 you are talking about, you can keep carrying that 100,000 as a possible tax benefit in your pocket. That even if year 4, you find yourself making taxable income, that should have been, or you have a tax liability. You say that, hey, GRA, remember in year 1, I had a tax loss of 100,000, which I've been carrying in my pocket. You need to allow me to utilize this to reduce my possible tax liability in year 4. So you can cumulatively be looking at year 1, year 2, year 3, and carry those losses with you and put them in your pocket to offset future tax liabilities. And that's why extension of it for the 5-year is a tax advantage that companies need to utilize. Now, the interesting thing, Dr. Boateng, is that from our practice, we've seen a lot of companies, because tax is not a proper issue or it's not something that they focus on, they lose out on a lot of these benefits that they can use to actually offset tax liabilities. And then sometimes you get closer and you ask yourself that, at least make sure that these things are very much on the discussion, because it actually saves you as much money as your revenue that you're making or your operations. Thank you.
Thank you. So still on you. So in your closing remarks, what will be your key takeaways to board of directors?
Thank you very much for your time. And I think this is a very interesting time for directors. And I think from what we see as KPMG, from what the budget statement and the proposals, I think there are about 3 things that we need to take away. One, and I think it's interesting that we are talking about ESG issues. If you look at one of the pillars, we are talking about governance. Now, the governance here, we are looking at making sure that your reporting, your compliance, and all those things are very key. You see that a lot of our stakeholders are very much interested. They want to deal with people or companies that actually are complying with local laws and others in terms of governance perspective. So I think we need to make sure that tax issues are becoming very things that in terms of compliance, reporting, making sure we are aligned, because our stakeholders have become very much aware that ESG issues, where the governance issues are making sure that they align with companies whose governance and internal controls and those things are actually, from tax perspective, are actually in sync. Another thing is looking at where the revenue measures are going. The GRA is going to be very aggressive, and I'm saying very aggressive. So you need to make sure that in terms of having your tax procedures, in terms of your compliance, reporting, paying taxes on time, and all those things, you address all those things. Because trust me that at the end of the year, when you see an assessment and the liabilities and all those things, you might as well not even have done your business, because you are just throwing away money if you fail to make sure that you are filing taxes on time, you are paying your tax dues on time, and all those things. So these should become part and parcel of business decision making in companies. And I think lastly, from a tax planning point of view, make sure that you get the proper support in terms of taking advantage of everything that is out there, so that you don't lose sight of it. And I think even the example that I gave, the tax losses, you could see this is a very exciting tax planning opportunity that a lot of companies are actually losing sight of. So please, I think it's exciting. We should all be bracing ourselves for that. Thank you, Dr. Boateng.
Thank you very much, Mr. Michael Boateng. Mr. Evans Asare, before you give us your closing remarks, I have three important questions from the venerable Professor John Bright Kobla Ahito. Prof. Ahito, I greet you, sir. Prof is asking, his first question is, are we now in a controlled economy or in a free market economy? That is Prof's first question. The second one is, why is anybody talking about government expenditure control in the budget? Why is nobody talking about government expenditure control in the budget? So I think, Prof want to know why we have to tighten our belts, but I think on the other side, the belt, nobody is, raising the bar for the belt to be tightened. And then the last one is, what happens if citizens decide to go to court to challenge what is being offered to them? And probably this may be a combination of debt restructuring, mark-to-markets, haircuts, and a combination of, probably all that. So, Ms. Evans Asare, if you got all these three questions, attempt them for us, and you would give us your closing remarks as key takeaways.
All right, thank you. This seems to be a triple whammy on me. from the venerable Professor Ahito. So I think maybe let me attempt to address the first question about whether we are in a controlled economy or a free market. In theory, we're supposed to be a free market economy, isn't it? Practicing capitalism, property owning democracy, and all that. That is what is underpinning the democracy we are practicing. But I think in every economy, governments make interventions. We saw it in COVID. It happened in the developed economies where they were doing quantitative easing, okay, just pushing money to be able to control, inflation and all that. So I believe that some of these interventions are necessary, even though we are in a free economy, we are in an open market environment or democracy, but we are at a point where government has to come up with some critical interventions, and some of these debt exchange programs and all these government interventions are critical at the point where we are now to be able to make sure that the economy, adjusts itself for it to find its own equilibrium. So at this stage, I think there is some kind of a disequilibrium in the system, and the economy needs to settle and to recalibrate itself to that equilibrium that we want. The second question is about why nobody is talking about government expenditure. I think maybe from the context we are in, let me paint this picture. Government has a certain fixed cost that it cannot do anything about it. So 2023 budget, for instance, compensation to workers is about 43 billion. You can't do anything about it. Interest payments that is budgeted is about 52 billion. Put together, it's close to 100 billion. It's like a fixed cost. You can't touch it. Government cannot do anything about it. Before we talk about statutory obligations, transfers to other funds, NHIS, GET fund, road fund, and all that. And then you talk about goods and services. Ministries would have to function anyways. Before you go and talk about the capital expenditure, which is about 26 billion or something, far, far lower than what we are spending on paying interest. So once we do the build up from fixed cost, you realize that government has a very little margin to be able to cut down expenditure, if you ask me. And my surprise was the fact that with all these rationalized expenditure items, government still wants to spend 205 billion next year. You're asking yourself, assuming we did not come up with all these expenditure cut measures, then where would we be? We'll be in about 220, 30, 40 billion in terms of expenditure. So that is the margin within which government would have to operate. Then finally, about the court case, I wish I had, some pocket lawyer somewhere to advise on this. But I think it will be in anybody's right to challenge some of these decisions in court. But the question is, how practical would it be? Even if you get a judgment debt today and the government should pay you, where would the money come from? So my closing remarks probably is that good companies, they say, thrive, great companies thrive during crisis. And therefore, we are in crisis. So we expect that companies would readjust, will recalibrate, will reset, will re-strategize to be able to thrive during this crisis. It will not be for long. I think in the short term, it will be difficult. We will have to make difficult choices. But I believe that in the medium to long term, when the economy resets and we find our equilibrium, we will be able to set ourselves on a path of growth. Thank you very much.
Fantastic. Just as Martin Luther King Jr. said, the ultimate measure of a man is not when he's swimming in comfort, but in times of difficulty. So this is a special time for board of directors to prove their worth and show that they can match up to the task. We'll go to Mr. Andy Akoto and take your closing remarks and your final key takeaways for directors.
Thank you very much, Doc. And I would want to also align myself to the concern expressed by Prof. Aheto, because clearly these times call for leadership. And let me emphasize it once again on the part of government, because it cannot be that the citizens are being asked to tighten their belts and it still becomes like business as usual on the part of government. And therefore, I can understand some of the frustrations underlying those concerns that have been expressed. And clearly, it will be in the bosom and in the right of any citizen to challenge government to its own commitments. Indeed, the finance minister in his presentation of the budget in Parliament categorically stated that it is a call for and a commitment to fiscal discipline. And there were a number of expenditure control measures that were itemized in the budget statement, including, for example, to do away with non-essential travel, fueling, high consumption vehicles such as V8, et cetera, et cetera, et cetera. But the question is, with which rigor are we going to see these expenditure control measures actually implemented? And I would also beg to differ from a point that Evans made earlier on regarding fixed positions regarding, if you like, current expenditure on the part of government. We've heard from various quarters the need for government, for example, at this critical time to cut, on the size of government and its functionaries. And I think it's a call in the right direction. If we did that, we may save a few cities. And I think it's something for government really to consider. But on the corporate level, I think it is a call to impactful governance on the part of all directors. Clearly, as Ivan said, there's a need to reprioritize and re-strategize, on what really needs to be done to secure equilibrium, even at the corporate level, and therefore prepare the organization to grow. In terms of some of the low-hanging fruits, again, we've heard it severally on this call. We can embrace digitalization and technology in taking advantage of some opportunities, regardless of which sector in which you play. There's also the need, once again, to consider ESG factors. And let me seize the opportunity to also advise or mention on this platform that KPMG will be coming out with a very, very novel ESG survey across businesses and organizations, just to get a sense of how we're, as a country, our maturity in even examining certain fundamental principles in moving towards this sustainability journey. And we'll obviously be sharing the report with all interested stakeholders so that we can pick the learnings from that and use that also to help us build a more resilient and robust economy, attractive enough to also continue to engender trust in the broader investor community. Thank you.
Thank you very much. We will so much be waiting to have a good read of that ESG report. And I'm sure, Mr. Andy Akoto, you know, I'll be the first person to read and get back to you. At this juncture, I will call on President Rockson Dogbegah. He's the president of IoD Ghana and also the president of ACG, and that's Corporate Governance Network Africa, to give us his closing remarks.
Thank you very, very much, Dr. Boateng, for a very great job. Well done. I wish to thank all our speakers for providing us with a very good insight of the 2023 budget to inform our strategy and decision-making process. As directors, with a very heavy dose of opportunities in the midst of the challenges and the economic turbulence. In fact, it has been very, very educative and engaging. I, however, know the following key fallouts. One, the need for directors to take along their management is key, and the review of our internal processes is very critical for our survival. Two, the need to re-engineer our value creation processes and building strategic close relationships with our regulators and other key stakeholders will be very crucial. Three, businesses need to be agile, competitive, and extend their markets beyond the domestic market. And according to the survey conducted by KPMG, 85% of global CEOs expect a recession, and therefore, the need to enhance our appetite as directors for continuous business improvement and switching to an agile mode to be able to respond to opportunities is also key. 4, businesses need to embrace ESG principles and champion sustainability concepts. 5, directors need to maintain strong monitoring evaluation and good relationship with its stakeholders. 6, directors need to invest in technology and take advantage of the technology platforms under PPA for business opportunities. 7, board members must acquaint themselves with the 10-point agenda for GRA and must be guided by the tax regulatory provisions to ensure proper compliance, including forest losses. 8, and here I would wish to speak about the Institute of Directors in response to the call made by Andy for the IoD to take charge of promoting governance outcomes in this country. And I wish to report as follows, that the Institute of Directors Ghana is making a steady progress in its quest to improve the governance architecture in this country by working collaboratively with critical stakeholders. And I want to share with you some of the success stories so far. 1, we are working with the Ministry of Public Enterprises and SIGA to stimulate performance of SOEs. About 3 weeks ago, we had an engagement with management of BOST and DVLA, looking at their performance and sharing in their success stories. B, in collaboration with the Bank of Ghana, the public and the private sector, the Institute has led the development of a national corporate governance code that seeks to harmonize existing sectoral codes and to make provision for sectors which have none. C, we have developed a director's bill to promote a director training and certification, which is currently on its way to cabinet. D, the Institute of Directors Ghana is embarking on a mass human resource mobilization project to develop a critical mass needed to promote the corporate governance agenda in the country by ensuring corporate governance training is included in the curriculum of all tertiary universities in the country. E, the Institute will be launching the Corporate Governance Code, the 3rd edition of the Directors Handbook, and celebrate its 5th Excellence Awards on the 13th December 2022. And let us all be part of this celebration. Distinguished ladies and gentlemen, moving forward, this event of discussing the annual budget will feature in our annual plans. The last one we had was in 2019. We cannot survive alone if we are left to promote the culture of good corporate governance, we need all of you on board. I would wish to encourage all our members, our guests, to become members of the Institute, not at the individual level, but also at the corporate level. Last but not the least, let us provide foresight to our management as directors. After gaining the insight, directors need to provide ethical and effective leadership and impactful governance to achieve organizational objectives. And finally, as I mentioned, distinguished ladies and gentlemen, we have a new CEO of the Institute in the person of Clement Wedu. He is a management consultant and comes with a rich experience of over 20 years. At this stage, may I crave your indulgence to invite Mr. Wedu to say a few words, and then we bring the proceedings to a close.
Mr. Wedu, activate your camera and let's hear from you. If you are on. Mr. President, I think Mr. Wedu might have gone offline.
Okay, so I want to thank you once again for your participation, and we look forward to a continuous engagement. Thank you very much and have a good day. Thank you.
Thank you very much, Mr. President. I think we bring a close to today's event, and I can't thank enough our partners, KPMG, for making time and sharing with us. And to Dr. Oduro Osae, we are so grateful that you made time to give us that insights. And to all of you who made time to join us, we say thank you very much. You can follow us on our social media handles, IoD-Gh, Facebook, LinkedIn, and you can also become a member to learn more about governance. We thank you, have a good day, and God bless all of us all. Thank you.